The theory here is that you're getting two very different strategies, and not both are particularly complementary.
That's right. Caroline, it's great to be here. Thanks for having me again. I'm Lily Lyman. I'm at _VC. We are a community-driven early-stage venture firm based here in Boston. We invest at the pre-seed and seed stages in the world of B2B software. And your question's the right one. We're seeing the emergence of two very different strategies in venture, and it's bifurcating the market in a way that almost looks like a barbell. On one hand, you have these big multi-billion-dollar, multi-stage venture firms that are mega firms. They're really sort of financial institutions at this point. And I hear LPs refer to these as venture beta. On the other side of the spectrum, you have smaller funds, more specialized, targeted strategies. That's where we at Underscore play. And it's because that's our belief of where you can still get venture alpha, that 3 to 5, even 10x return. What's happened over the last 18 months or so, though, is we're seeing a heavy concentration of LP dollars going into the mega funds. So 80% of capital raised last year went to established managers of firm sizes over 500 million. And the representation of these firms is increased. So it's gone from about 2% to 25% in the venture market. And that overrepresentation has a lot of implications for LPs, for managers, and for founders.
Okay, let's talk about what it means for Underscore VC. Ultimately, are you going to see more consolidation among the seed, the pre-seed stage, or actually do you need the breadth of more focused funds, and it's actually in consolidation that you have in the middling?
I think what it means is I think we're going to see, more specialization at the earliest stages. So firms like ours, that you need to really lean into differentiation and get to founders early, and also back perhaps non-consensus, not obvious, both founders and ideas, because that's how you can capture true alpha. What's happening with the multi-stage strategy at the seed stage is that they play more of an index game and putting out a lot of checks and then backing the ones that are winners. But the implications of that is that they're not always very price sensitive in that, and it can dilute the entire early stage class if you can't, counter that and really dig in and go earliest and non-consensus. So that's how we've been thinking about it in order to counteract some of the implications of the multi-stage indexing model at seed stage.
It kind of takes me back to when SoftBank first unveiled their $100 billion fund, and everyone feeling that the Vision Fund was just going to give enormous amounts of money to individual founders or companies and sort of drown out the rest of the competition. Is that what happens, or is it just more that it inflates valuations? What is the real impact on those very early stage bets?
I think it can have multiple impacts. I think on one hand, the indexing can impact valuations for everyone, and so it can actually dilute the returns across the board. But on the other hand, if you can get in early, or if you can invest in sort of non-consensus, I think you still can generate that real alpha. I think part of the implications are questions for founders as well. I think we're seeing founders think a lot about who do they bring around their table at which stages of company building. In the market peak during the ZERP era, there was a lot of speed dating. There was a lot of capital that went out the door very quickly. And then 2 years later, we had a much tougher environment, and it was hard for founders. And so I think we're seeing founders, both new founders and sophisticated founders, think about what kind of investments and investors do they want around their table for each stage of company building, and thinking more about this question of alignment. What does that check mean to that firm, and how does that infer how they'll show up during the company building process?
I'm assuming that most founders you're seeing are having to lean into generative AI, even if they are not an AI-specific company. But what does that mean in terms of trying to uncover the least covered areas, or the particularly non-consensus builders and founders you want to find?
We're certainly seeing a ton of opportunity in AI, and over 30% of venture capital of this past year went into AI companies, and we expect that number to increase next year. But what we're seeing is companies that are AI native, both in their products that they're offering, but also in terms of how they're being built. I think one of the things that makes this time particularly exciting to be an investor at the earliest stages is companies are being built with a new model. I think with a new capital structure, you can do a lot more things more efficiently. Engineering can be much more efficient. Sales and marketing can be much more efficient. And so I think there's a mentality of, do more with less, achieve more with less. And so in many ways, outside of a certain bucket of types of investments, like foundational models and infrastructure, I think where we invest a lot of the applied AI, vertical AI applications, I actually think you can build pretty big companies with a totally different capital structure, given the increased efficiencies of building with AI itself.
How many of them are in Boston, or are you looking across the US?
We invest across the U.S., but we're very bullish on Boston. So over half of our capital is deployed here in Boston, and it's because this is an ecosystem that continuously produces the top talent in the world. It continuously produces some of the top research and development in the world, and it increasing, it consistently solves really hard problems. So things like healthcare and biotech and life sciences and financial services and cybersecurity, and energy and climate. So these three factors are part of what gets us very excited to invest in the Boston ecosystem, particularly in this age of applied AI.